Hi everyone and welcome to the Everyman Investor. So in today's video, I'll be taking a look at the recent rise in stocks over the past week or so, and taking a look at the factors that affected the market and why the bulls are in charge at the moment. However, the bad news is that there is a but to the whole situation. Okay, so this is the S&P 500 ETF, the SPY, over the past month or so, and it's been rising and rising and rising again. The reason for that is very simple. The inflation data has been coming in light over the past few reporting periods. The previous week actually saw the consumer price index being released. Now, the CPI basically measures the cost of daily life for the average consumer, and the rate of year over year was increase of 3.2% versus 3.3% expected. Now, the Fed's target is 2%, but the consumer price index is trending in the right direction, which basically gave the market the idea that the Fed will not increase rates again. In fact, there's talk about the Fed decreasing rates soon, and that will be favorable for stocks in general. Now, what the Fed actually prefers is actually the core CPI. So the core basically takes out energy and food because these are more volatile elements in the calculations. Now, the core was 4% versus 4.1% expected. Again, it's trending very nicely downwards, which is deflationary, which is basically good for stocks if the Fed decides to cut rates or hold its rate steady. Now, I prefer to look actually at the producer's price index because this is a forward-looking measure. So what happens is that the producer price index measures the cost of production, and it's rising at a rate of 1.3% year over year. Taking the core into consideration, it's rising at 2.9% year over year. Now, if the producer's price index basically is slowing in terms of its inflationary rise, then it will flow through to the consumer in the future months. As production costs decrease, consumer costs will automatically decrease, assuming people do not go and profit from the inflationary sort of situation. And many retail companies are actually sort of being criticized for profiteering from the current inflationary environment. So what this means is that treasury yields are dropping because people expect the Fed to either hold it steady or to cut rates. And this is good because the equity risk premium now favors stocks, which is why this nice little bull is actually staring us in the face and it's ready for a run. However, there is a but. Okay, so let's take a look at what's happening. So the recent release of the hedge funds data in terms of their quarterly filings about what they've been buying and selling. Now, we take a look at the most famous of all buy and sell investors, which is Buffett, and Berkshire actually sold net 5 billion more stock than he bought, which is basically says that Buffett doesn't think that there's value in the market at the moment and has not finding good opportunities to invest capital. Now, this is from the Motley Fool, but if you go and look up on Google, you can find many articles about Buffett basically being a net seller this quarter. In fact, he's been a net seller for the year as the markets have been going up, which sort of goes to his mantra of being wary when others are greedy and being greedy when others are fearful. So, is there any basis for this caution? Now, for those of us who have been following earnings from the retailers, many retailers are actually being very cautious about their guidance over the next quarter, even the next year or so. Many retailers are saying that consumer spending is somewhat slowing, and also that consumers are being more picky with what they spend on, and they might be going for house brands versus, say, premium brands. And this is not really good news. So a couple of weeks ago, I shared that Apple doesn't see any growth in its sales, and this is sort of reflected in many of the retailers. You can go and check it out on CNBC. This is just a summary, but if you've been following the retailers' earnings releases over the past couple of weeks, it is all very consistent with this summary. The other problem is this is the credit card debt for US consumers. This is from the St. Louis Fed. So as you can see, credit card debt is basically at its all-time high, which is not good. So what it means to say is that the consumer is running out of his COVID savings, and the consumer is using debt basically to buy purchases. Now, what happens if the consumer spending slows? So this is from the White House, basically. Now, the important thing is what is underlying in rate. So consumption, which is consumer spending, actually makes up 2/3 of the US economy on average. So basically, as the US consumer goes, so goes the US economy. Meaning, if the US consumer stops spending, US GDP is going to drop, and that can lead to a recession. And that is where the but comes into the picture. So overall, the inflation numbers are looking good in terms of the Fed not being aggressive in either raising rates anymore or perhaps even cutting rates, given that treasury yields have fallen tremendously over the past week or two. But at the same time, if the consumer is starting to show weakness, and if unemployment rises, consumers will definitely be affected even more. So, in general, have I been buying? Yes, I have been buying actually. I've bought 4 times over the past couple of weeks, mainly on billings or revenue misses or on reduced guidance, um, which led to a pullback of about more than 10% on the stocks that I bought actually. So the thing is, there are still companies to buy. You just have to be very careful. One of the stocks that I bought actually is Fortinet, which basically dropped after its billings missed again, and it dropped to less than $44.50, which is what I picked it up for. By the end of that trading day, it went up to $50. In short, in one trading day, I actually made 12% if I sold, but I am not selling because Fortinet is still growing long term. And I actually learned something useful from watching Palo Alto's earnings, listening to Palo Alto's earnings call, where the CEO actually spoke about what billings actually mean to a company's prospects. And I'll go through that in a future video on billings. So in general, I would say that it's good to be careful because very seasoned investors are actually seeing dark clouds on the horizon. This is backed up by the retailers who are saying that consumers are getting more cautious. But at the same time, should inflation fall and should wages keep up with inflation, the consumer might not weaken as expected, and we might get a soft landing, which is basically reduction on inflation to the Fed's target without a recession. So I hope this was informative, and I will update on any future important events that happen, as well as any news regarding the markets and how it might affect your investment thesis. So thank you for watching, and for those who celebrate Thanksgiving, happy Thanksgiving. And for those who don't celebrate Thanksgiving, well, I guess we can find something to be thankful for as well. So thank you, and see you in my next video.